In a previous video, we talked about selling put options as a way of buying shares in the future at a discount. In this video, we will be sharing with you how to use put options to make money using a line of credit without actually using this money. The strategy we will be explaining is a zero-cost trade called bull put spread. The steps to the approach we will consider are as follows. Number 1, sell to open a naked put. Number 2, place an order to buy to open a put at a lower strike. This we call a lead. Number 3, use the released buying power. Number 4, go back to 1 and repeat the process. Step number 1, sell to open a naked put. We pick a company we like fundamentally, which is at a low point of $8, and the next high point looks like it will be at 12. We'll sell to open a $10 naked put that will expire in 3 months or more. We choose 10 because this is a midpoint between the low point of 8 and the high point of 12. Let's say we receive a $3 premium per share, that is $3,000. For 10 contracts, we agree to buy 1,000 shares at the price of $10 each, therefore an investment of $10,000. Step number 2, place a trade to buy to open a put at the strike right underneath the previous one we just sold. In this example, we'll place an order to buy to open a $9 put, offering approximately 10% of the premium we just collected in the first trade, that is 30 cents. For 10 contracts, we will have the option to exercise the put and sell 1,000 shares to the market at $9 a share, that is, we will receive $9,000. By buying the lead, our risk decreases from the initial $10,000 to $1,000 because we have the option to buy the shares for $10,000 as well as the option to sell the shares for $9,000, which is a reduced risk of $1,000. Even though the risk is $1,000, the net credit is $2,700 because we received $3 per share when we sold the 10 put, that is $3,000 for the 1,000 shares. We spent 30 cents per share when we bought the 9 put, that is $300 for the 1,000 shares. The net credit of both trades is $3,000 minus $300, $2,700. Possible outcomes at or before expiration. Number 1, share price greater than 10, we make $2,700. Number 2, share price less than 9, we make $1,700. Number 3, share price ends up between 9 and 10, we make somewhere between $1,700 and $2,700. If both put trades are executed, the result is a zero risk and zero cost trade, out of which we make between $1,700 and $2,700. Step number 3, reduce the buying power. The initial risk of $10,000 has gone down to $1,000, thus granting us $9,000 buying power extra that we can recycle and use to start the same process again. By reducing the buying power with the lead and recycle this buying power into selling a new naked put, we get to open more positions in different industries, which helps diversification and asset allocation. Find us at Empowered Supernova and www.ticn.ie. For more information, contact us at anna@ticn.ie, ana@ticn.ie. Thank you.